Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about 160 Health International Limited Annual Report. 160 Health International Limited offers a diverse range of businesses and services that cater to various needs in the pharmaceutical and healthcare industry. At its core, the company provides wholesale and retail distribution of pharmaceutical and healthcare products in China. In addition to product distribution, 160 Health International has developed the Healthcare 160 platform, an online platform that offers digital healthcare and wellness solutions. This platform caters to multiple segments, including business customers, medical institutions, medical professionals, individual users, and third-party merchants. The services provided through the Healthcare 160 platform include online marketing solutions, digital hospital solutions, and online healthcare services. These offerings enable businesses and individuals to access a wide range of healthcare-related products and services in a convenient and accessible manner. 160 Health International Limited market capitalization of $14 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that 160 Health International Limited holds a significant advantage in their industry. 160 Health International Limited trades at a higher price-to-book ratio of 46.6 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 130% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the sale of pharmaceutical and healthcare products has shown significant growth, with an increase of 3.9% in sales. Additionally, digital healthcare and wellness solutions have also contributed to revenue growth, with a notable 7.6% increase. The synergy between these two areas has further boosted revenue, as well as cross-selling opportunities for pharmaceutical and healthcare products. Furthermore, the company's diversification of revenue sources through strengthened supply chain and distribution capability has led to expansion of online healthcare services. Collaboration with medical and healthcare institutions and professionals has also been a significant driver of growth. The establishment of city stations in key regions has enhanced localized services, contributing to overall revenue growth. On the other hand, potential drivers of revenue decline include early termination of contracts, loss of customers, compliance fines and penalties, rising governance costs, and increase in business costs. However, it is worth noting that these factors are not explicitly stated as primary drivers of revenue decline. Net income experienced a significant increase of 720% year-on-year, marking the company's first profitable year after deducting non-recurring items. This improvement was largely driven by cost reduction and efficiency enhancement through AI technology integration. However, net income later decreased due to compliance fines, rising governance costs, and increased business expenses. Profit margins also underwent changes across different segments. The overall gross profit margin improved by 0.3%, increasing from 25.8% to 26.1%. This was largely attributed to cost control and operational refinement in public hospitals. In contrast, the digital healthcare and wellness solutions segment saw a decline of 1.2% in its profit margin, dropping from 79.3% to 78.1%. Meanwhile, the pharmaceutical and healthcare product sales business segment experienced an increase in profit margin by 0.1%, rising from 1.5% to 1.6%. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest data, the company has achieved a positive operating cash flow of RMB 340,540 in 2025. This is a notable milestone for the company, indicating that it is now able to cover its operational expenses and invest in growth initiatives without relying on external funding. The positive operating cash flow also suggests that the company's business model is sustainable and scalable, providing a solid foundation for future growth and expansion. The company's debt level has undergone significant changes over the past year. While there have been instances of decreases in certain categories, such as property and equipment, these have been offset by increases in other areas like borrowings. In fact, borrowings have seen a notable rise across multiple pages, indicating a substantial increase in the company's debt. Regarding interest expenses, the picture is more complex. On one hand, there are instances where interest expenses have increased significantly, such as from RMB 3,656,000 in 2024 to RMB 6,241,000 in 2025. However, on other occasions, these expenses have decreased, like from RMB 1,456,000 in 2024 to RMB 646,000 in 2025. Overall, the trend suggests that interest expenses have increased in some cases but decreased in others, making it difficult to pinpoint a clear direction. The company's performance varied across different segments and regions. On the positive side, the pharmaceutical and healthcare product sales business segment showed strong results, as did the online marketing solutions, specifically digital healthcare and wellness solutions. These areas demonstrated growth and success. However, some segments and regions struggled. China faced significant challenges due to extreme weather events, rising costs, labor shortages, and a decline in revenue. The company's business model also experienced difficulties, including rising costs, labor shortages, and declining revenue. Furthermore, the value chain was disrupted by supply chain issues and damage to warehouse facilities. Additionally, hazardous waste disposal operations underperformed. The performance of other segments and regions is not specified in the provided information. This includes digital hospital solutions, online healthcare services for individual users, and the global region as a whole. Management is optimistic about the company's outlook and strategy. The key areas of focus include driving digital transformation in healthcare institutions through AI integration, strengthening presence in the in-hospital business sector, and advancing product innovation. A new AI-powered risk management solution will be launched to improve medical quality and safety. The company aims to expand its online healthcare services to meet evolving user needs and is exploring international business expansion to target global markets. To achieve this, it plans to build a smart and agile digital supply chain for pharmaceutical and healthcare products. Research and development investment in artificial intelligence will also increase. In the long term, the goal is to become a world-leading internet medical and healthcare platform by 2025. Financially, the company will utilize cash generated from operating activities, external borrowings, and other funds raised from capital markets to satisfy liquidity requirements. This strategic approach positions the company for sustainable growth over short-term financial performance. The company's financial history reveals a consistent practice of distributing dividends to its shareholders. This is evident from the explicit confirmation on pages 170 and 209, where it is stated that dividend distribution is indeed yes. As such, it can be concluded that the company has paid dividends in the past. There are concerns about inventory buildup in the company's operations. The data suggests a significant increase in inventory purchases from approximately RMB 18 million to RMB 20 million, 56,000 between 2024 and 2025. This substantial rise in purchased goods at cost indicates that the company is holding more inventory than before. Furthermore, the cost of inventory sold also increased during this period, rising from RMB 435,903 in 2024 to RMB 419,442 in 2025. While this may seem like a decrease, it's essential to note that the overall trend suggests an accumulation of inventory, which can lead to inefficiencies and potential losses if not managed properly. The recognition of inventories as an expense during the year ended December 31, 2025 was higher than in 2024, indicating that the company is struggling with inventory management. This could be a sign of supply chain disruption or inefficient inventory control processes, which may have significant implications for the company's future performance and profitability. That concludes the financial summary for 160 Health International Limited. Feel free to comment below, and I will be happy to answer them when possible.